Hello, everybody, and welcome to the Investing with IBD podcast sponsored by Vantage Point. It's July 20th, 2022, and we have on the show, as always, Irusha Pires, O'Neill Global Advisors portfolio manager, joining us to help me walk through and make a sense out of this market. Welcome back, Irusha.
Thank you, Justin. Always great to be here.
And also helping us out, Will Rhind is coming back on the show. He is the founder and CEO of GraniteShares. We had a great discussion last time Will was on. It was at one of those critical moments when so many headlines were coming out. So we're going to revisit a lot of those same topics that we were talking about before. So welcome to the show, Will.
Thank you, Justin. Good to be back on. Thank you.
Yeah, I can't wait to get into it. So one of the biggest things that we're going to be talking about today is kind of the macro drivers behind this market. And certainly when we had you on, it was like mid-March, and we had the Ukraine situation was pretty new. Inflation fears were just starting to rear their head. We had yield curve inversion, Fed possibly tightening, but 75 basis points off the table, and wow, what a difference a few months makes here. So, Will, maybe you could just start out with some opening comments on kind of your overall take of what's changed in the last few months.
Yeah, I think that what's changed, and that's, if anything, to be honest with you, because I think things were fairly bearish, at the start of the year when markets started to tumble. But I think things have just gotten more bearish. In other words, the tightening that we've seen from the Federal Reserve, has really tightened financial conditions, and we've seen continued, up until last Thursday, basically, continual falls in stocks, and to a lesser extent with the bond market. But I think that's really been the key concern here, is that, from where we were, things have just gotten worse. And we've got some people obviously saying, we're in a recession already. And that's now, I think, the big sort of topic next that people will have to move to, which is maybe not a question of if we're going to go into a recession, but when. And is that going to happen sometime this year or sometime next? Or like I said, there are a few people who are already saying we're in a recession. So there we go.
And so, Will, with the commodities falling, especially over the last few weeks, does that indicate that we're getting closer to the end of the business cycle? Because a lot of times when you have that kind of inflation with all the money there pushing up the commodities, and then rates start increasing, now those commodities might start falling. Are you looking at it like that, or are you looking at this, maybe the commodities are in the middle of maybe a big pullback, but could start making newer highs later in the year?
I think that traditionally that would be, I think, a great sort of indication. When you start to see prices falling, it's typically really only an indication of one of two things. Either supply has increased and or demand has fallen. We know that supply has not really increased. I mean, there are some commodities, some of the oil stocks, that there have been a build up in the last few weeks. But really what's driving it, in my mind, are, yes, increased fears over recession. But I think we just have to caveat that with, there is a bit of a premium, or the premium, I should say, that was in the market over Russia, Ukraine, that has started to come out of the market. Most commodities now are trading sort of where they were before Russia invaded Ukraine. I mean, there's still a couple of commodities, oil and nat gas, that are still up on that. But for the most part, that premium's come out. The second big thing is that you've got China, which is obviously one of the world's largest consumers of commodities, that effectively went into lockdown. And that's really affected demand. And as we all know, that was ultimately the thing that drove oil prices not just to zero, but to negative for a brief moment in 2020, when the world essentially locked down and we had no demand, or huge demand destruction for oil. So that's really my only caveat here, is that I think if we're talking about a normal scenario where the world was operating normally, I think it would be a dangerous sign, or certainly a sign that things are not right, and that we are perhaps moving into a recession quicker than normal. I think we've just got to be a little bit cautious about saying that right now, given obviously that premium coming out as the Russia-Ukraine war sort of moves from the front pages to the back pages of the newspaper, so to speak, and China's going through this very difficult period, but particularly their response to it and the demand destruction that we're seeing coming out of that market.
And maybe you could kind of tie this into the strength of the dollar, because certainly that's one of those things that does have an effect. There's so many variables in there. So what's your kind of take on the strength of the dollar as it pertains to the commodities and other areas, the bonds, everything?
Yeah, well, I mean, for commodity markets, and let's just extend this to any market, any country, any economy that's not dollar-based, it's big trouble. This is really bad news, and particularly if you look at the euro. The dollar's now highest against the euro for the last 22 years. Look at some emerging markets around the world. The dollar's wreaking havoc, with those particular economies. And so obviously for commodities, the vast majority of commodities, they're priced in US dollars. So if you're in a foreign country that's not on the dollar, you have to buy those commodities in US dollars, which means you have to raise, foreign exchange reserves to get dollars. And as we've seen, particularly in a case like Sri Lanka, if anybody's been following that story, the country has collapsed. And one of the reasons for that has been lack of availability of dollars, as they haven't had the ability or haven't had, the ability to raise funds to fund debt liabilities and access to commodities such as oil, gasoline, etc. So it's big problems for the world, outside of the US, when you have a dollar as strong as it is in economies that are as weak as they are at the moment.
Yeah, and well, I actually have family in Sri Lanka, so I definitely know from a personal side where how much there's my family's struggling over there. Do you think that's maybe the first kind of domino to drop, and you're going to start seeing other countries starting to potentially suffer the same fate as Sri Lanka's been going through over the last few months?
Yeah, absolutely. And again, this is nothing new. This is what we tend to see in periods where there's a strong dollar and weakness in emerging markets. We know already today there's headlines about Pakistan having some troubles. But again, it's not surprising that countries just like the United States, just like European countries, have taken on large amounts of debt, and that needs to be financed. A lot of that debt has been in dollars or is in dollars. And if you have a lot of dollar debt, and obviously you need to finance that, you need to repay that, it's going to be very challenging with the exchange rate differentials the way that they are.
Right. And so now let's maybe get a little bit into the whole inflation side of things. Again, this is something that's just weighing on markets, on the economic outlook. And again, some people are blaming it. First we were told it was going to be temporary, right? And then it's like, oh, well, maybe it's kind of here to stay. And then the Fed got really serious about, no, we really need to do something, and we need to act aggressively. So you've got this combination of high inflation, the highest in 40 years, and then you also have the recession fears. Wages going up. It's still a tight labor market. Do we get like a wage spiral? Stagflation like the 70s. All of these fears that people are talking about. What is it that you make of kind of this whole dynamic with the inflation talk?
Well, I think as we've seen, Justin, that inflation is a real big problem, and it's something that first of all, the commentators, the Federal Reserve, obviously at the top of that chain, that were calling for transitory inflation. This was a short-term phenomenon. That was proved to be epically wrong. And I think that a lot of inflation people are starting to realize as it's not just that it's more enduring than being transitory, is that some of it will be deeply entrenched. And once you start getting this sticky inflation, particularly with wages. I mean, once you give someone a pay rise, you can't take it back.
Right.
Really, the only way that ends, or the only way that finishes, is in a recession. People are let go, and that's how the job market or people's comp is sort of marked to market or reset, if you will. But yeah, once you start giving people pay rises, once that's baked in to Social Security, to other things that are keyed off of salaries or compensation, you can't take that back. And we're seeing that from food, from consumer goods, anything that is rising is proving to be more sticky. The good news for people that are kind of panicking about inflation is that there are some signs that there are areas of the market that are cooling, and commodities clearly is one of those places where inflation or these commodity prices have cooled over the last few weeks for the reasons that we just talked about. And I think there are some signs elsewhere in the economy that there might be some relief coming, but it just looks increasingly like that really the only cure for this, unless you're a believer that the Federal Reserve can really control this, is that ultimately you have to drive the economy into recession in order to bring these prices down, which is obviously the outcome that nobody wants, but it might be what's inevitable.
Right, and speaking of potential recession, now you have the yield curve inverting by quite a bit, right? I mean, before it was like what, 4 or 5 months ago, or a little bit longer that where it inverted a little bit, but then it kind of got out of that.
I think it was right when Will was on last.
Oh, was it?
In mid-March?
We talked about it on the show. I remember.
Yes.
Yeah.
So now this time it's like even more inverted, right? So
I don't know. Is it every time we have Will on we're going to talk yield curve inversion? Are you the Grim Reaper of the economy?
So does that mean that the odds are we're likely just going to go into a recession? And is it going to be more of a soft landing type of thing that obviously the higher ups are hoping that they somehow pull off?
Yeah, I mean, it's one indicator, and clearly it has been an indicator or a pretty good predictor in the past. Clearly, none of us have a crystal ball. We can't say whether this alone is the surefire indicator that we are locked in for a recession. But certainly it's worrying, and clearly the reason why people look at it and why it's important is because when you have a yield premium on short-term debt versus long, then it tells you that something's not right in the world. That you should be paid a premium accordingly for holding longer-term debt, not short-term debt. And so that kind of tells its own story. But I think that really we got to look at the broader implications of all of this, and it's clear that the Federal Reserve's tightening credit conditions, that's obviously showing up in the market. That's just showing up in the stock market. I mean, showing up in the real estate market, with mortgage rates increasing and financial conditions tightening. And so I think it starts that process whereby we're slowing down, and where we land, obviously, who knows? It's difficult to say, but I think it's tough to be able to engineer some kind of landing. I think that you're ending up in a position which is much more market driven.
Right. And I mean, there's so many variables that go into it, and again, you kind of have seen already the forecasting confidence that people have in the Fed right now is probably pretty low. And again, just getting back to the yield curve, again, I think we were looking at the 2-year and 10-year before, but now, I mean, 1 year and 10-year inverted. And you and I were talking yesterday, and it's like the 6-month, kind of inverted.
Oh yeah, it's right at the beginning of the curve as well. And I think the Fed, it's hard because you don't want to criticize them too much.
It's a hard job.
But for many years, remember the mandate was to stimulate inflation, and that was to get inflation to around 2% or slightly higher. And they weren't able to do that. That was to engineer some inflation in the economy. And so I guess the odds on now of them being able to do the reverse are sort of stacked against them. But clearly they're going to give it a try.
Right. Okay, well, when we come back, that kind of gives us a good sense of what's been going on. When we come back, Will's going to talk to us a little bit about what we do now. And we're going to talk about, whether it's a hedging time, income investing, what's the path going forward here. So stay tuned. We'll be right back. Hey, trader, listen up. The markets have changed. Have you changed your strategies? Vantage Point can help you conquer volatility. Learn to trade with AI. Visit www.freestockcoaching.com and discover how to predict market trends 1 to 3 days in advance with up to 87.4% proven accuracy. No matter which way the market moves, Vantage Point's patented AI can give you a massive edge. Visit www.freestockcoaching.com to get what you need to find your best entries and exits. That's www.freestockcoaching.com. Trading involves financial risk and is not suitable for all investors. Past results do not guarantee future performance. Okay, welcome back to the Investing with IBD podcast, sponsored by Vantage Point. It's Justin Nielsen here, along with Irusha Pires, who joins me every week. And our special guest this week is Will Rhind, founder and CEO of GraniteShares. So, Will, we were talking a little bit about a lot of the macro drivers, and I think we pretty much hit everything. Between inflation, the Fed, the geopolitical issue with Ukraine, yield curve, everything like that. So, I guess the question is, how do you see us kind of coming out of this? What should investors be doing to kind of position themselves? A lot of times it seems like any bet that you make and the market kind of turns, as soon as you get comfortable with it. What is it that you're seeing, and what is it that you're kind of projecting out there for people?
Well, clearly it's been a very, very bad, first half of the year, and we've seen, for example, a 60-40 portfolio, assuming 60% US stocks and 60% US bonds, have one of the worst starts to a year on record. Mm-hmm. And what does that mean? It means that people who perhaps have gotten used to nothing but positive returns, now are sitting on position where they're losing money. Financial advisors have their clients calling, shouting at them because they're down on the year. And I think what all of this means is that we're going to see a lot of money in motion in the second half of the year, because that's people are going to take an opportunity to tax loss harvest, some of those losses in the portfolio, and hopefully people still have gains if they've been in the market for a number of years elsewhere. But I think people are looking to do that, and then we'll see some movement in terms of people looking, do I stick with this and sort of ride it out, or do I make some changes here? And sell out of maybe bonds or equities, but could have repositioned the portfolio. And so I think from that perspective, we're going to see a lot of money in motion the second half of the year. People try and navigate their way through this.
And where generally does that kind of motion lead towards? If you have a lot of market participants lose a bunch of money, are they going to try to put it in more aggressive kind of ideas or more kind of conservative points at this time?
I think so far, what we've seen is clearly a trend towards the more conservative. In other words, what's the lesson we've learned so far? The lesson is, if you hadn't had commodities in your portfolio over the first half of the year, you've almost certainly lost money. It was really the only money-making trade of the first half of the year. And I think in an inflationary environment, the lesson here is that people have to look to things like commodities that not only have the potential to perform well in an inflationary environment, but give you a different return stream to traditional equities and bonds. The other thing clearly we've seen is people shy away, I think, from those speculative areas of the market, from those risky and more speculative areas of cryptocurrencies, the profitless tech stocks, the things that were obviously probably the most popular over the last couple of years. And I think, that there's been a renewed focus in, things like cash, defensive positions, dividends, or yield producing investments, and things you probably would expect, in more, difficult times, that people are becoming a bit more conservative. And I think that's only natural given what we've seen, first half of the year. So perhaps it's, the return of capital taking precedence over the return on capital as we move into the second half of the year. And I think, one thing that I am watching, and one thing I am concerned about and have been concerned about for a while, is that the earnings, that obviously the stock market at the end of the day really lives and dies on the earnings. And the first two quarters are actually pretty good in terms of earnings. The earnings that we're seeing now clearly is a bit of a mixed bag, but already starting off to be okay. And I think that's one of the reasons why you see this rip higher in the market, certainly since Thursday of last week. And really, I think my thought there is that if we start to get a crack from some of these mega companies that make up, as far as the indices is concerned, such a big part of the market, your Apples, your Microsofts, etc. If those companies miss, and we haven't seen that yet, I think that is bad news for the market and could be the sort of the next catalyst to bring things down. So far, things seem to be holding up, and that's why the market's taking that very positive. But I think as we go later into the year, we still have a high inflationary environment. We still have a strong dollar, which impacts foreign earnings of some of these mega tech companies, and we have this continuing tightening of financial conditions. That could show up in the earnings and be a big catalyst for another leg down. But we'll see. So far, companies have been pretty resilient.
Yeah, there's certainly that, the multinationals often, I don't know, it almost seems like a little bit of an excuse, like, oh, but it's not our fault. The strength of the dollar. Well, there's nothing we could have done. No way we could have imagined that. But I want to kind of get back into a little bit. One of the commodities that we didn't really touch on too much is gold. And with this high inflationary environment, gold is kind of the traditional, the store of value, your inflation hedge. But it certainly hasn't seemed to be that way more recently. So, and then maybe we could show a chart. What chart are you showing here now?
GLD.
Okay, so GLD. So, for those that are, looking at the podcast, the video version, and you can find that at investors.com/podcast. I know that GraniteShares has a GraniteShares Gold Trust, which is BAR, ticker symbol BAR.
Right, yeah.
But what's happening with gold? Why did it kind of fail as that inflation hedge?
Well,
or has it?
Probably another podcast on this, another hour. But in short, look, I think gold has not done badly. Gold's down 10% year to date, so it's outperforming stocks. And again, you have to couch this in the context of the strongest dollar market that we've had for a long, long time. And again, if you're measuring it in terms of some other foreign currencies, the strongest dollar we've ever seen. So remember the gold price, we're talking about the US dollar gold price as being down 10%. We're not talking about the gold price measured in other currencies where, depending on what currency you're looking at, gold is already at a high, indeed some cases an all-time high. But the dollar price of gold, this is a challenging environment because you have super strength in the dollar, and that's driven off the back of rising interest rates, which is kind of the cocktail that gold least favors. But I think given that, the fact that gold has hung in here and is certainly down less than other assets in the market shows that it's resilient, and that this is a time when people are still looking for that alternative, that store of value. I think really the question for anybody from now on is what seems elevated right now? Gold at 1690, or certainly a few $100s off its all-time high, or the US dollar. And certainly in the context of that, you would think, and again, it's not a crystal ball or anything, but you'd think that the dollar probably has more room to come down versus gold at this stage. And indeed, once I think the Fed gets to a point whereby the market is more comfortable with the direction of travel regarding interest rates, that I think that's probably the catalyst that starts to at least stabilize the dollar, if not cause the dollar to fall, relatively quickly. But clearly we're not there yet, and that's what a lot of the concern is, and a lot of the interest in the dollar right now.
Yeah, and that's so tough. And you're talking about relative, gold falling relatively, not doing that bad versus a lot of other things. I mean, that's always so hard, unfortunately. Well, I mean, it's understandable if you have to if you always have to be invested in the market. So then it's kind of, yeah, okay. My portfolio is down 20% versus other things that are down 25%, but it's on an absolute level or kind of a emotional level that's always hard, especially for some investors if you have that chance to go to cash. What are your thoughts about that? Like, so for instance, like a gold, kind of having a gold allocation, is it a 5% type of allocation to portfolio? Higher than that? Do you raise it in kind of uncertain times? How do you look at adding like maybe a bar to your someone's portfolio?
Yeah, I mean, the way that we've always looked at it is the first and the easiest thing to say is you have to have enough for it to be relevant in the portfolio. And what we mean by that is people talk about abstract percentages. And you say, okay, I have 1%, or I have 5%, or 7%. And I think the point is, if you hold 1% of anything, the chances are it's not going to have any impact on your portfolio. So regardless of what happens in the market, it's just not statistically significant to impact your portfolio. So that kind of leads you to automatically having a higher allocation. We've always sort of felt like 5 to 7% was a reasonable number for that, but clearly that can flex depending on your particular situation or how the portfolio is designed, who the client is and their level of risk tolerance. And indeed, you get plenty of portfolios where the allocation to gold and commodities would be materially higher than that. But I think in this environment, if anybody's, people are cautiously positioned, gold is something that historically has held value in volatile times. And right now, like I said, no one likes to lose money. Of course they don't. But from a relative perspective, given the challenges or the headwinds against gold, I think it's hung in there well. I mean, certainly from a supply-demand perspective, the fundamentals are good. The supply of gold is relatively constant. We've had central banks buying, which is a good sign. Investors are still buying. The holdings, as measured by the ETFs, are not as high as they were clearly when gold peaked in 2020, but they're still pretty elevated, which means there's good support at this level. And clearly, if we're going into a recession, and indeed hard economic times, and particularly with credit tightening, that starts to perhaps maybe give have some worries about credit itself and default levels. It all sounds a little bit similar to what we had back in 2008, and it's a time when your gold performed well, because once people get nervous about the market, once people get nervous about credit or counterparty risk, then clearly gold, above anything else, is an asset of the highest quality that does not have any credit or counterparty risk. So it's something that, like cash, that people have historically flocked to, in times of crisis.
Mm-hmm. Now, maybe you could talk a little bit, because you've mentioned, okay, there's the hedging aspect of things, and when people are looking for really places to hide and not get hurt as bad. Another area is those dividend producers that you mentioned, and I mean, whether it's the utilities or a lot of the REITs have been doing well, especially like you've got your apartment buildings and the rents are going up. Where does that fit in with everything? I mean, you certainly would think of again, apartment buildings as being something that's good to have, because the rents are going up, and that's going to be kind of correlating with inflation and kind of doing well during that. But on the other side, you've got commercial real estate that was getting a little iffy at some point, as people were wondering about the whole return to work. So what do you do in terms of that kind of income producing side of things, dividend yields?
Yeah, I mean, dividends, clearly they're valuable at this particular time, because anything that generates cash and cash flow in these kind of times is prioritized over perhaps the traditional growth investments that people have favored the last couple of years, which typically don't generate any cash, because a lot of those companies are not even profitable, let alone to generate a dividend. But if you look at inflation just more broadly as a construct, and you think about what tends to do well in inflationary environments, you come down to hard assets or real assets. Mm-hmm. And in the real asset bucket, you have commodities, you have gold, which you've already talked about, but you also have real estate, and you have assets that are real physical things that pay a dividend or pay a distribution. And that is something, utilities clearly are also another area of the market which are much more defensive that over the past couple of years, I'm sure people didn't really pay much attention to, but that people are looking at those more seriously now. And then again, there's just the general market environment where stocks are down, and so dividend paying stocks that people are looking to transition to now, you're buying a dividend stock perhaps much cheaper than you were at the beginning of the year. And so by definition, the yield might be higher, right, on those stocks, and they might be attractive enough for people to pick them up at these levels. And clearly there are energy-based stocks that pay good dividends, and so there are stocks that are operating or enclosed in these hard asset or real asset sectors of the market that not only provide you with some income, but might also have the potential to do well, or at least relatively well, in this environment.
And so now with going back to kind of the real estate comments, with the rates rising, the mortgage rates going up, does that affect REITs a lot, or do they already own those properties and so they're just still collecting the rent payments, and hey, maybe more people will start to rent versus own?
It sort of depends. So again, broadly speaking, if you split the REIT category into two, you get equity REITs on one hand, which are just any REIT that owns physical property. That could be single family housing, that could be commercial real estate, that could be malls, but physical property. Now, on the other hand, you have mortgage REITs. So those are REITs that own the mortgages.
Right.
In a rising interest rate environment, mortgages are going to do worse because rates are rising, and typically mortgages are set at a certain rate. Now, over time, those rates will adjust, and those investments you'll be able to move up. But if you're in a recession, you have concern about delinquency, concern about defaults, etc. But it's really the equity REITs that tend to do well or perform well in inflationary environment, because that's the physical property itself.
Okay.
Now, obviously, if you get into a condition where you're into recession, then clearly that can impact anything, because demand for housing, etc., come down. So it's not immune from that by any means. It's just in a sort of inflationary environment, typically those hard assets or real assets are things that tend to do well.
Mm-hmm. Well, and this kind of gets back to our whole thing about a relative winner can still be an absolute loser, in terms of the relative versus absolute terms.
Absolutely.
So, and again, with some of these income producing plays, as you mentioned, they have gotten hit, they have come down, and so for people that were holding this and kind of saying, oh well, I'm getting my a healthy 5% dividend, which is much higher than what the S&P 500 is giving me. If you're down 15%, what does that 5% dividend matter, really? You're still down in absolute terms, maybe down less. It's as you said, it's all relative. Yeah. But I guess a lot of people are looking at cash as not being great to hold on to in an inflationary environment. But if it's going down less than anything else, is that a relative winner?
Well, it is. I think some famous hedge fund manager, very recently said cash is trash. And I think that was, in the context of, high inflation or rising inflation, right, but in a stable to an economy that was growing. And I think that sort of was relevant maybe for that particular time. But like you said, now where you have the stock market or assets falling faster or falling more than the rate of inflation, cash doesn't look too bad in terms of, yes, okay, you're eroding, your cash value has been eroded in real terms by the inflation rate. But if you put that into stocks and they've fallen twice as fast, then you probably still be much better staying in cash. So I think a lot of people are now, going back to my point, starting to revalue statements like that in terms of thinking, well, actually, is it really the right thing to be doing, to be in the market sort of above all else? And is it time to put some money into cash, or indeed, if you're in cash, to keep money in cash in case there's another leg down in the market? So I think that's sort of where a lot of people are right now. And to your point about the dividends, I mean, we have a fund, HIPS is the ticker code, HIPS, which is a high dividend paying a high distribution ETF. And right now, that pays just over 10% per annum. Now, obviously, that 10% is a function of the fact that it's a fixed dollar distribution against the share price, which has fallen this year because the market's fallen. So it's fallen, in line with the broader market, and depending on what period you look at. So assets are down, or the value of the portfolio is down, but you're getting a very strong distribution for that. So I think for people that value and prioritize income right now and prioritize cash flow, it's something that can be valuable to people in a portfolio where it pays a consistent distribution every month. But like you said, there's no free lunch in this world, and for people that can buy investment like that when the market's down, you profit from that high level of income. But the flip side is also that the reason why it's high is because the underlying portfolio has fallen, and it's fallen because the market's fallen.
Right.
Now, from a kind of a larger perspective, and obviously there's another kind of big, large generalization here, but what do you think the market needs to see to slowly turn this around to get out of this bear market?
That's a great question. I mean, I think that really everything is driven. I mean, I shouldn't say everything. I'd say almost everything is driven by the Federal Reserve at the moment. I think we had this mantra for the last decade, or certainly since the global financial crisis, which was "Don't fight the Fed." And what "Don't fight the Fed" meant was that in an environment where the central bank was easing, broadly speaking, that you were to buy equities or buy assets and buy the dip. Now it's the reverse of that. Central bank is very clearly tightening, raising interest rate, financial conditions are tightening. And so in this context, "Don't fight the Fed" might mean don't buy the dips. And indeed, or certainly be cautious about doing it until I think the market gets some kind of clarity or is confident enough in the direction of travel. Now, it might come as a shock to people listening to this show, but already the market is pricing in the first rate cut for Q1 next year, which might sound absurd to some people listening. And in many ways, it is absurd, but what that is signaling is that interest rates can only go up so far, and at that point, or close to that point, the market the economy will start to tip into recession, or already be in a recession, of which the reaction to that the Federal Reserve will have to reverse course and start cutting rates. So that's kind of, I think, in a nutshell, where we are, and everything is going to be keyed off of this central bank policy. Now, obviously, clearly we could have a nasty surprise coming out of Russia, Ukraine, an escalation. We could have, any number of, I suppose, geopolitical events that are somewhat unforeseen, which could make things significantly worse. But I think, leaving aside that, and just talking purely about markets, stocks have already taken a pummeling for the most part, since the beginning of the year. So portfolios are down, valuations have reset a lot, considering where they were at the end of last year. I'm not ready to say that things are fairly valued, or things are certainly not willing to say things are cheap in this market. But I think it's really all about what happens to interest rate policy, and do we have clarity on where that's going. And I think in the next 6 months at some point we'll get a better idea for that.
Well, maybe we have you back on then and we can kind of see how things pan out. But Will, thank you so much for joining us today. And again, you're the founder and CEO of GraniteShares. Where can people find out more information about some of your offerings? Do you tell people to go to the website or Twitter? What's the best?
Yeah, the best way is always just to go to the website, because we're an asset manager. All the products and things are displayed just on our website. That's the primary place people can go and check it out. So it's graniteshares.com, just as the name sounds, granite like the rock, shares.com. And people can have a look at what we do, and obviously if you've got any questions, etc., please contact us directly.
Wonderful. Thanks again for coming back on the show, Will. We really appreciate it.
Anytime. Thanks, Justin. Great to talk to you. Thanks, Irusha. Good to see you again.
Definitely.
Okay, and when we come back, Irusha and I are going to take a look at some of the technical action going on in the markets and see if we can find any stocks that look like they're setting up in this rougher environment, but strong rally lately. Stay tuned. We'll be right back. Hey, trader, listen up. The markets have changed. Have you changed your strategies? Vantage Point can help you conquer volatility. Learn to trade with AI. Visit www.freestockcoaching.com and discover how to predict market trends 1 to 3 days in advance with up to 87.4% proven accuracy. No matter which way the market moves, Vantage Point's patented AI can give you a massive edge. Visit www.freestockcoaching.com to get what you need to find your best entries and exits. That's www.freestockcoaching.com. Trading involves financial risk and is not suitable for all investors. Past results do not guarantee future performance. Okay, everybody, welcome back to the Investing with IBD podcast, sponsored by Vantage Point. It's Justin Nielsen here, along with Irusha Pierce. We just had a great conversation with Will Rhind, but now we're going to kind of give you the IBD take on the markets. We kind of looked at the macro factors, the macro drivers, and now let's kind of see where we're at in terms of the market action. So we did leave the market action in uptrend under pressure. And I'll tell you a couple of the reasons why. This was kind of a debate that we were having at the end of the day. But if you go ahead and pull up the NASDAQ composite, and again, for those of you watching the video, that's at investors.com/podcast. And if you look at the NASDAQ composite, one of the things that still concerns us, as strong as this rally is, and we got basically, if it looks like volume came in heavier today, so that means it's a subsequent follow-through day. Yesterday was a subsequent follow-through day. So you got back above the 50-day moving average line. You got the moving average line starting to stack properly. It looks like the 10-day is trying to get above the 21-day. The 21-day is trying to get above the 50-day. So you've got a lot of things that are kind of going for the market right now. But you also have kind of a lack of a lot of individual stocks looking strong, and you still have, while we got over this recent resistance at around 11,650 or so from, that we kind of hit our head on a couple times lately, you have, right there, 12,300, even 12,000, a lot of congestion around there. And then it just seems like the places where we could hit our head continue. And you could also be looking at channel lines, in a downtrend here. So it seems like we're getting kind of up to the upper end of what has been this downtrend. So we could get turned away at this, channel line too. So there's still reasons to be cautious, but that's a lot. What's your take, Irusha?
Yeah, no, I think you captured it pretty well there, Justin. We got past some short-term resistance, that 12,300 area on the NASDAQ. That's going to be kind of the key part. It is interesting with the moving averages starting to slowly get over some of the longer term. That could indicate that maybe we start to bottom out here. Maybe you start to put in some kind of we were talking about bottoming bases last week, right?
Right.
Maybe you kind of put in a bottom range in the markets here if it can hold. These are always the hardest times for Can Slim O'Neill type of investors. Because you have a lot of stocks that aren't necessarily breaking out of bases. There are all the stocks that have gotten beaten down. They're reverting back to the mean. They're the ones coming up. And a lot of the stocks or the few stocks that are foreign bases, they're not doing much, or they're kind of crawling up on lower volumes. So you're kind of in this, if you're using our strategy, you're kind of in this no man's land where you still want to, for the most part, be patient. And kind of let the market continue to provide an environment for stocks to build more and more bases.
Right. Yeah. And I mean, look, I was looking at a quick sort of the NASDAQ 100 earlier in the day. So I'm not sure how these ended, but I'll tell you, just in my quick sort, looking at what was up the most, it felt like it was 2020 again. I mean, you had Datadog, Atlassian, so DDOG, TEAM, Zoom Video was up there, DocuSign. I mean, it was just all the old hits coming back. And I mean, heck, to that end, I mean, look at ARK, the ARK fund, ARKK. That was up 5% and, coming up off of its bottom. So it really did feel like a lot of this, kind of bottom fishing. And that reminds me a little bit of how I kind of messed up 2009 to a certain degree. It was, it felt like in 2009 that I just couldn't find anything. It was looking at things like some of the biggest moves were coming from Ford, Bank of America, Citigroup, the things that had dropped into like $1, after,
right.
They were in danger of getting delisted from the New York Stock Exchange because the stock was so cheap and you were having reverse splits just to keep them on the exchange. But those were the ones, as you said, that were mean reverting. And doing very well. So I guess it comes down to what's an investor to do? What's a cancelim investor to do in this environment, Arusha?
Yeah, well, I think the main thing is to be patient, right? You have to wait for your setups. And now there are some setups out there that are slowly working, and so you could try a few of those. And we had that follow through day, what, a month ago. We're still under
Hmm.
pressure. And so you could, you still could, if some of those positions haven't stopped you out, you still have some of those. We've been making progress. You could look to add another one. And it's really that incremental process. I think the big thing is not to lean too strongly one way or the other. You don't want to be too bearish. I mean,
Right.
it's been pretty tough for a long time, but there is going to come a time where the markets are going to turn, and you're not going to be ready for it, right? You're just going to say, "Oh, it's just a bear market rally. It's going to probably hit new lows in the near future," and it's not. Right. And
Hmm.
so you want to always kind of have that doubt, or kind of keep that open mindset. Wait a minute. The markets have had a chance over the last few weeks to make lower lows, especially when that CPI number came out.
Yeah.
And, it seemed like, okay, here we go. We're probably going to start testing the 10,500 area, because that number was, always pretty bad and fear
Hmm.
inducing, right? So, but the markets always love to do the opposite, and so kind of got everyone out who wanted to get out, and it started finding a little bit of a floor here, and so it's not necessarily a surprise that it's finally gotten back above the 50-day. We'll have to see. It wouldn't be a surprise for it to test that 12,300 area, and there is going to come a time, Justin, you spoke about this a few weeks ago when we looked at a number of bear market rallies. Some of these rallies can be like 40%,
Yeah. Right. That's
50%,
September
right?
2001. Yeah.
Exactly. And
Hmm.
so I don't know how far away that 200-day moving average is. Let me switch over to the Qs here and take a look to see if we have. So on the Qs, that's only 12% away. That looks like a really long place away, right? That's only 12%. So if we kind of continue this momentum and everyone's kind of leaning too far to the bearish side, you could have a rally potentially up to that 200-day, because no one believes that the market can rally, right? So you just have to keep an open mind. I think the biggest thing is move slowly, incrementally in. If you see some stocks that are looking interesting to you, but be disciplined, and feel free to have plenty of cash still until the market truly proves itself.
Yeah. I mean, again, if we're going to go up, to the 200-day moving average line, there's still time to get in. You don't have to feel like you have to panic, and certainly you want to avoid buying extended stocks. It just seems like that's been a place of potential danger. I mean, even a lot of breakout failures have been happening. So, I thought it was cute when you said, oh, if you bought stuff on the follow through day and you didn't get shaken out, like what are you talking about? What are you holding that you didn't get shaken out? Because it seems like I've been going, more and more short term just to not get shaken out. Taking profits into strength where I can. And of course, what's going to happen eventually is I'm going to be taking those profits into strength and thinking I'm all smart, and things are going to continue going, and I'm going to be like, oh, now nothing's set up. So there's always that kind of balancing act that you have to figure out. So
Yeah,
let's
I have two very tiny pilot positions in, and they haven't stopped me out yet. So that's just kind of giving me the feel for the market. And just very
yeah
quickly, just underneath the surface. So the growth to 50 this past weekend has 171 stocks,
yeah
which is still pretty low. We'll have to
yeah
wait to see what it does, the new number on Friday night. And there are probably like 20 stocks within the growth 250 now that are setting up. So
hmm
a little bit more of a larger number in the near pivot than we've had in a while. So that might be changing a little bit. But where we're going to get a lot more confident is once you start seeing a lot of bases setting up underneath the surface, and
hmm
then you start seeing the market really starting to work. That's where we'll all have much more confidence, because there'll be a lot more opportunities to get more exposure in the market. Right now, you only have a little bit of opportunity.
Right. I just want to add two things. Number one, I think it's critical what you just said there. The things that you haven't gotten shaken out of were your smaller pilot positions. This market has certainly been one where some of those pilot positions have been the way to go so that you can hold on to them. because there's just been, with some of these stocks, a lot more volatility, and you have to kind of almost give your stocks a little bit of room. But if you're going to protect your portfolio, that means you've got to do a smaller position. So I mean, there's that element, and then when you were talking about more setups on the near pivot, one of the things that is still striking about that is, there's a lot of these, tight areas, and you look at it and there's a cash offer there, so
Yes,
make sure if you see some really tight action, that you look for that CO on the chart, because that means that it's basically, had an offer out there, and that's why the tight action is kind of gravitating towards that price. So just be careful of that. So yeah, let's go ahead and get into some stocks, and maybe we can start out with one of the areas that I feel like continues to have a lot of setups is the biotech, healthcare, medical. We keep on seeing these names, these groups getting up in the ranks. So you have INCY, which is Incyte Corporation. This is a biomed biotech stock, number 16 out of 197 for the biomed biotech group. And this is a big group, 800 names basically in this group. And here we have cup with handle, blue dot, relative strength rating of 93. There's kind of a lot that is your traditionally in place. Now, some of the fundamentals aren't quite there. So what's your take on this one, Irusha?
Well, the first thing after Ken Shreve's excellent episode last week is, hey, this could be a bottoming base, right? This sold off over 2020 and 2021, so corrected quite a bit. It's been making higher lows over the last few months, and so there's a divergence versus the market. While the market was making new lows, this one has been fighting it for a while, which is why you see that relative strength line kind of shoot up right there. So at least now, for the first time in over a year, it's setting up a base. Pattern recognition is picking up a base that we recognize. So that is a positive right there. Now, a lot of times, so I think from just in a vacuum for Incyte, if you're looking at just the price and volume action, that's positive that it's actually slowed down enough for us to recognize a pattern. Now, on the fundamental side, it's a little disappointing that that doesn't have a lot of earnings. And so if you're looking more from kind of a broader perspective, is this really the best biotech stock to get in? Probably not. I'm guessing here it's probably not. Now, one thing about what you said about that number 16 for the biotech 800 stocks, a lot of money has to go into this area to move it up our list that much. So that is really impressive to me. It seems to me that Wall Street's starting to put a lot more bets in this area. And so you really ideally want to focus on some of the stocks that probably have better metrics than an Incyte. So that's kind of the initial thing. I mean, what are your takes, Justin?
Yeah, and I mean, this kind of likens back to our discussion not too long ago with Nina Deca from Robo Global. All of that discussion that she had on the healthcare sector, things that are going for it, long term, why more money may be moving there in terms of, all different areas. So I think that's interesting. But with individual stocks, I think you always have to take a look at, what does their pipeline look like? And I think that's where a lot of times I might shy away from an Incyte, because I kind of get afraid that, if one trial goes wrong, or one FDA approval doesn't, pan out, does it have enough of a pipeline to absorb that? Does it have enough revenue from different sources that, one failure isn't going to knock it out? And I mean, remember that a lot of these biomed biotech stocks are plunging money back into their research and development. So for Incyte, 48.8% is their R&D number. And that's, incredibly high, but a lot of times what the biomed biotech area does. So let's go ahead and move on. Another area that seems like it's been kind of getting a little bit of traction is some of the retail, surprisingly. I did see some of the apparel names looking interesting, and one of the stocks that we talked about with Ken last week was Ollie Bargain Outlet. So in particular, the discount variety, look at that, number 4 out of 197 groups for that group. Again, a lot of members in here that are setting up, looking interesting. Right now, on the face of it, this stock just looks extended. But on the daily chart, what kind of interested me is that we're getting a pullback here, and so I just wonder if this can continue pulling back, does this give you another opportunity? The 21-day moving average line is not too far away, but we could get a bounce there, or even let that 50-day moving average line catch up a little bit as the stock comes down. Does that potentially give another opportunity on this one?
Yeah, I think eventually this is going to set up, and it's really up to each individual whether they want to try off the 21-day or the 50-day, right? So a lot of times the stronger stocks in a market, they'll hold that 21-day a little bit longer, and so it will give you a chance quite a bit earlier if you're waiting for a pullback to 21-day versus the 50-day. So 4% away from touching the 21-day. So that's just something to keep in mind. It is really extended right here, but like we spoke about with Ken last week, I'm showing a lot of strength here. And it continues to show a lot of strength, and they may be turning the corner. I always think about Ollie's bargain outlet way back when they came out public. And I think I bought it at the exact same time as David Rhind, but I think I took my 20% profit, and David held it like for a year and a half and had like 100% profit or something like that.
A few
Right?
hundred percent.
So, yeah, exactly. So it
uh,
was pretty cool to see him do that. But it's a really interesting concept. We actually went together to an Ollie's bargain outlet a few years ago when we were out in Myrtle Beach for an event. And so we walked around and looked at the store. It is a treasure hunt. So it was kind of mind-boggling how much of a treasure hunt it was. But there's a lot of great bargains in this. So if they're fundamentally turning it around, and it seems like the market, we're not necessarily seeing it on the numbers just yet.
Right.
But it seems like the market's kind of betting on it. And so it is acting well. I think it's worth keeping an eye on the watch list on this one. The retail discount variety store is number 4. I don't know if that's a great thing for the market or says great things about the market.
Recession fears.
Exactly. But you're right. Yeah, there are a number of stocks within this group that are acting well, and so they are all worth keeping an eye on. They might not necessarily go up a tremendous amount, but especially if you're looking, we were talking about relative in the previous segments, if you're looking for some relative outperformance, a number of these stocks have that potential to outperform relatively if the economy continues to get worse.
Yeah. And it's interesting that for as bad as those growth numbers look right now, I mean, you just are seeing a lot of red. You look at the 2024 estimates, and holy cow, they're big turnaround there. And again, I guess the assumption is that they're going to be getting more and more of this, merchandise, that they're going to be buying for pennies on the dollar, and that's where they do well. I mean, it's the old pick and save model from the 70s that Bill made so much money on. So let's go ahead and wrap this up with Cal-Maine Foods. The ticker symbol on this is CALM. Again, we've been seeing still that a lot of the setups, kind of in your more traditional type of base pattern, that's up above its 50-day moving average line. It's up above its 200-day. The moving average lines are already stacked in a favorable way. A lot of those names are coming from the more defensive areas, and so certainly food, meat products. In this case, Cal-Maine Foods is about all about the eggs, the shell eggs that they're distributing. So you've got the formation of a cup here, and what's your take on the technical action, Irusha?
Well, I think the technical action looks pretty healthy. It wouldn't be a surprise to see it maybe pull back a little bit. It's had a great run over the last 3 or 4 weeks. When you look at the volume, some good accumulation coming in there. There's a lot of blue bars there. So and some heavy blue bars there too. They got through earnings, and it looks like they reported pretty well, up 999%. I mean, that's the maximum on markets, but it's probably in 4 digits there, right? So
well, and it was calculating it off of a negative too. So
okay, fair enough. Yes.
So you can see those triangles there. You know, that's telling you that there were, you know, some non-recurring items, and then the number sign, the hashtag, I guess is what they call it now, right?
Yeah.
That tells you that it was being calculated off of a negative. And you know, maybe just for people watching the video, you can just kind of go to that left-hand corner where the chart legend. So if you're ever wondering what some of these things are on the MarketSmith chart, you can always click on that chart legend, and it'll bring up something where you can just hover over things and find out, oh, what is, you know, what do these numbers mean? What do these symbols mean? And so on. But yeah, go ahead and again, it's hard to deny that, you know, 999 is pretty high.
No, I mean, strong prior upturn before, building a decent cup here. Another kind of reason why to be a little bit more concerned about the market if you have a food stock looking like a tech stock
Right.
from 2020. So this is yeah, when you pull this up now, because I've been hearing about it, but I haven't really taken a look at the chart. It does. I mean, it looks pretty strong. It's doing everything right now. The only thing is that it's kind of in the middle of no man's land right now, where halfway through the base, it could easily pull back, or it could keep going up. But it's hard to kind of define your risk or really come up with some kind of manageable trade at this point. So this is more a watchlist stock.
Well, and it goes back to your point that it seems like there's a lot of patience required right now. You have some of these stocks that are kind of on the more traditional side. If they can move higher, and you know, maybe this market is showing more bottoming signs, then you know, maybe it is finally that turn more into the growth. But on the other hand, if you're seeing it continue to be on the more defensive side, you know, that's telling you something too. If it's favoring a recessionary environment with your Ollies and your auto zones and things like that, you know, then that's telling you something too. And you just have to, I guess, adjust accordingly. But a lot of this could be a little bit of wait and see, and still sit on your hands to a certain degree.
Right. A lot of times it's the ones who are patient enough to and disciplined enough to wait for the fat pitch. They're
Yeah.
the ones who are going to really kind of capitalize on the next bull market. If you're just constantly swinging and trying at any stock that's on a technical basis breaking out in a tough market, the odds are you're going to get whipped around a lot. And so by the time that next great bull market comes around, you've been stopped out so many times, you're traumatized from getting shaken out all the time, that you're going to be a lot more gun shy to take advantage of that next great bull market. So patience and discipline is a great thing, but that being said, you still want to get a little bit of feedback in the market, add a little bit of positions when the market is turning, because no one ever really knows when the market's actually going to turn and the next great bull market's actually going to start. And so you have to keep that open mind and be flexible that, hey, you know what, my position right now could be wrong and I might have to switch if the market tells me so.
Mm-hmm. You got it. And again, to your point, you know, just wait for that fat pitch. I mean, that's certainly what Stanton did yesterday at Dodger Stadium for the All-Star
Right,
game, right? And that's where he earned that MVP spot with that home run. So hopefully, if you're patient enough to wait for that fat pitch, you can be getting some home runs yourself in the market. So that'll do it for us this week. Thank you so much for joining us, and we will be on next week with just Irusha and I. This is where our editor usually comes on and starts singing songs about, you know, Reunited or just the two of us, all sorts of things he can do. Hopefully he'll join us for that and maybe do a rendition of something. But until then, thanks for watching us this week, and we'll see you next time. Take care. Make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.